As of November 2023, the S&P 500 has taken a bit of a tumble, dropping about 10% since August 1st. While market corrections are never a walk in the park, they do come with a silver lining. They let you grab some excellent stocks at discounted prices. These moments can be the golden ticket for patient investors. Every year we're gifted with a few of these chances, and it appears that this is one of those moments. So, in this video, we're going to dive into 5 top-notch stocks that not only come with attractive valuations thanks to this dip, but also pack some serious growth potential. Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. Stock pick #1. RTX Corp, RTX. Let's kick off with RTX Corp, previously known as Raytheon Technologies, a major player in the U.S. defense industry. With a market cap of $114 billion, RTX has faced a rough patch recently, with a 12.5% drop over the last year. The real hit came around the end of July, when they had to recall an engine related to their Pratt & Amp Whitney division, causing the stock to plummet nearly 20%. This appeared to be an overreaction, especially considering the company's subsequent announcement of a whopping $10 billion share buyback plan. Such a move by the management indicates their confidence in the company's stability despite the engine recall hiccups. The current global climate, with conflicts in Ukraine and the Middle East, underscores the importance of having some exposure to defense contractors. RTX fits the bill as one of the best in the business. Looking at the numbers, analysts project an EPS of $5.46 per share, resulting in a PE ratio of 14.4x. To put this in perspective, over the past decade, RTX shares have typically traded at an average earnings multiple of 18x. 22 analysts follow this stock, and they have an average 12-month price target of $91, suggesting a 15% upside from the current levels. And it gets better. RTX offers not just potential share price growth, but also an annual dividend of $2.36 per share, equating to a 3.0% yield. The company has been consistently increasing its dividend for nearly 3 decades, boasting a 5-year dividend growth rate of over 5%. Stock pick #2, Lowe's companies. Lowe. Now let's talk about Lowe's companies. This stock is a favorite among dividend growth investors due to its history of strong and consistent dividend growth, plus the potential for share price appreciation. Although the recent share price growth has been a bit sluggish, it's an excellent opportunity for long-term investors. This is precisely when you load up on quality stocks like Lowe's, knowing that the tides will eventually turn. The recent market dynamics led to a 5% decline in Lowe's stock over the past 12 months. However, since September 1st, the shares have retracted by a substantial 20%. This decline is largely attributed to rising treasury yields and high mortgage rates, now exceeding 8%, which have weighed on the stock. Lowe's and its competitor, Home Depot, are often linked to the housing sector, which has had its share of challenges lately. However, the housing market, and by extension Lowe's, won't stay down for long. Smart investors should see this as a buying opportunity. Let's look at the valuation. Analysts expect Lowe to generate 2024 EPS of $14.53 per share, which equates to a PE ratio of just 12.8x. To put this in context, over the past decade, Lowe shares have typically traded at an average earnings multiple of 20x, highlighting a substantial difference. 35 analysts track this stock and have set an average 12-month price target of $244, indicating a potential 32% upside from the current levels. On top of this significant growth potential, Lowe's is renowned for its consistent dividend increases. In fact, it's a dividend king, having raised its dividend for over 50 consecutive years. The company presently yields a dividend of 2.4% with a 5-year dividend growth rate of nearly 20%, an impressive feat. Stock pick #3, Merck and Amp Company, MRK. Next up is Merck and Amp Company, a pharmaceutical company that has managed to shine in a rather gloomy 12 months for the healthcare sector, which has seen a 4% dip overall. Merck recently reported their Q3 earnings, and it was good news all around. They not only beat expectations on the top and bottom lines, but also saw revenues grow by 7% year over year. This growth was primarily fueled by the star drug, Keytruda, which achieved a 17% year-over-year sales increase, totaling $6.3 billion. Given these strong Q3 results, management has revised their full-year guidance upwards, increasing both sales and EPS forecasts. For the upcoming year, analysts are projecting MRK to generate EPS of $8.43 per share, translating to a PE ratio of just 12.3x. To put this in context, over the past decade, MRK shares have typically traded at an average earnings multiple of 15.3x. It's not as dramatic as the Lowe's case, but it's still a noticeable difference. With 28 analysts covering the stock, they have set an average 12-month price target of $123, implying a 16% upside from the current levels. On top of that, Merck is a dividend growth stock, offering a dividend yield of 2.8% and a 5-year dividend growth rate of 10%. They've consistently increased their dividend for 12 years and counting. Stock pick #4, the Hershey Co., HSY. We're all familiar with the Hershey Company, one of the giants in the global candy industry. However, the stock has been in a sustained downtrend since May, presenting a potential opportunity. Hershey boasts a market cap of $40 billion, but in the past 12 months, its stock has taken a nearly 20% hit. Since the start of May, the shares have plummeted by more than 30%. Several factors have added to the stock's woes, including high inflation, leading to increased input costs that the company has tried to pass on to consumers. Additionally, discussions about miracle weight loss drugs have contributed to an unwarranted belief in the sudden transformation of the U.S. into an extremely healthy nation. But the Q3 earnings report from Hershey showed resilience, with beats on both the top and bottom lines. Revenues rose by 11% year over year, and the company is anticipating full-year EPS growth between 13–15%, a commendable feat given the current economic environment. In the upcoming year, analysts expect HSY to generate EPS of $10.23 per share, resulting in a PE ratio of 19x. To compare, HSY shares have historically traded at an average earnings multiple of 24.5x over the past decade. This stock is followed by 24 analysts who have set an average 12-month price target of $229, suggesting over 20% upside from current levels. Hershey is also a dividend growth stock, boasting a 5-year dividend growth rate of 10% and having increased their dividend for 13 consecutive years. Currently, HSY shares yield a dividend of 2.5%. Stock pick #5. Meta Platforms, Meta. Our final selection doesn't quite fit the traditional dividend stock mold. It's a growth stock. Meta Platforms Inc. is well known for being the parent company of Facebook, Instagram, and WhatsApp. It's worth mentioning that Meta has been among the top-performing stocks in 2023, trailing only Nvidia in terms of returns. This year alone, Meta's market cap has ballooned to $771 billion, with its shares surging by a whopping 131%. Even though Meta's stock has recently faced a bit of pressure, falling by 12% in the past few weeks, it's still an enticing proposition from a valuation perspective. In its most recent quarterly results, Meta exceeded expectations both on the top and bottom lines. During that quarter, revenue shot up by 23% to over $34 billion, and profits nearly doubled to $11.6 billion. Meta's CEO, Mark Zuckerberg, has labeled 2023 as the year of efficiency, meaning the company is looking to manage costs more responsibly. This has led to reduced spending and significant layoffs to align its workforce more closely with expectations. The last quarter was truly remarkable, but management issued cautious guidance. They hinted at the possibility of advertising spending slowing down, which is a critical part of Meta's business model. A similar situation unfolded with Alphabet, a close competitor, due to a miss in cloud growth estimates. So how affordable can a growth stock like Meta actually be, especially after posting an incredible 10-month return of 130%? Surprisingly, It's one of the few value plays when it comes to mega-cap technology stocks, often referred to as the Magnificent Seven. Analysts are anticipating Meta to generate EPS of $17.43 in 2024, translating to a forward PE multiple of just 16.5x. Over the past 5 years, Meta shares have typically traded at an average multiple of 23x, and over the last decade, that number was closer to 28x. These projections make it clear that Meta is poised to achieve significant EPS growth, 66% in 2023 and 22% in 2024, giving it a PEG ratio of 0.75. This indicates that shares are quite economical relative to the growth you can expect. With 56 analysts covering the stock and an average 12-month price target of $370, there's potential for nearly 30% upside from current levels. Investor takeaway: all 5 of these companies are of high quality and are currently trading at attractive valuations. While there's no guarantee against further downside, especially given recent increases in volatility, the present valuations in these stocks are compelling. Though it seems we've avoided a recession for the time being, the possibility of one occurring in 2024 remains. This is why it's prudent to maintain positions in high-quality stocks that offer substantial value.